On Wednesday morning, March 8, 2023, Silicon Valley Bank was one of the top 20 banks in America, $209 billion in assets, $175 billion in deposits, the financial backbone of nearly half of all U.S. tech startups. By Friday morning, it was dead, seized by regulators. The fastest bank collapse in American history. $42 billion withdrawn in a single day. A bank run fueled not by panicked grandmothers lining up at branches, but by WhatsApp groups, Slack channels, and Twitter threads. In 48 hours, a 40-year-old institution that had survived dot-com bust, the 2008 crisis, and a pandemic simply evaporated. And the scariest part? Almost everyone saw it coming, and almost nobody did anything. The 48-hour death of Silicon Valley Bank on the morning of March 8, 2023, Greg Becker, the CEO of Silicon Valley Bank, sat in his Santa Clara office and made a decision that would destroy his company in less than 48 hours. He wasn't panicking. He wasn't committing fraud. He was doing what every textbook says a responsible CEO should do when facing a liquidity crunch. He was being transparent. He announced that SVB had sold $21 billion worth of securities at a $1.8 billion loss, borrowed $15 billion, and planned to raise $2.25 billion in new capital to shore up the balance sheet. It was supposed to be a show of strength, a proactive move, the kind of thing that makes investors say, "This bank has its act together." Instead, it was a death sentence, because Silicon Valley Bank was a normal bank, and its customers weren't normal depositors. SVB was a bank of the tech ecosystem, venture capital firms, startups, biotech companies, the people who move faster than anyone else in finance because their entire business model is built on speed. Nearly half of all U.S. venture-backed tech and healthcare companies banked with SVB. 44% of venture-backed companies that went public in 2022 were SVB clients. The bank had grown from a niche player founded in 1983 to a $209 billion behemoth, the 16th largest bank in America. But its deposit base was concentrated, correlated, and catastrophically connected. Here's what SVB had done during the pandemic, when the Federal Reserve slashed interest rates to near zero and money was practically free. Tech startups were raising billions in venture capital, and they were parking that cash at SVB. Deposits tripled between 2020 and 2022. The bank had more money than it knew what to do with. So it did what banks do. It invested. But instead of making loans, which are risky, illiquid, and hard to scale quickly, SVB bought long-term treasury bonds and mortgage-backed securities, safe government-backed, yielding a steady 1.79% in a world of zero interest rates that seemed like free money. But there was a fatal flaw. Those bonds were long-term. The deposits were short-term. And when the Federal Reserve started raising interest rates aggressively in 2022 to fight inflation, the value of those bonds cratered. A bond yielding 1.79% is worthless when new bonds are paying 4% or 5%. SVB was sitting on billions in unrealized losses that didn't show up on their balance sheet because accounting rules let them hold those bonds at book value rather than market value. As long as they didn't sell, the losses didn't exist. It was a time bomb wrapped in a spreadsheet. Meanwhile, the tech sector was bleeding. Venture capital dried up. Startups that had raised massive funding rounds in 2021 suddenly couldn't raise another dime. They started burning through their cash, the same cash sitting in SVB accounts. Deposits began flowing out, slowly at first, then faster. By early 2023, SVB was hemorrhaging money, and its $21 billion bond sale on March 8th was the moment the mask came off. That $1.8 billion loss wasn't just a number. It was proof that the bank's entire strategy had failed. And then the internet did what the internet does. Within hours of SVB's announcement, venture capitalists were in motion. Peter Thiel's Founders Fund pulled all its money. Union Square Ventures advised portfolio companies to withdraw. Coatue Management sent warnings. These weren't rumors spreading through back channels. They were coordinated. Explicit instructions flying through WhatsApp groups, Slack channels, and Twitter threads. The same network effects that had made Silicon Valley so powerful now turned against its own bank. By the morning of March 9th, the run was on. What happened next was unprecedented in banking history. In a single day, March 9th, 2023, customers withdrew $42 billion from Silicon Valley Bank. Let that number sink in. $42 billion in one day. The previous record for a bank run was Washington Mutual in 2008, which lost $19 billion over 16 days. SVB lost more than double that in 24 hours. By the end of the day, the bank had a negative cash balance of $958 million. It was insolvent, not theoretically, not eventually. Right then, CEO Greg Becker tried to stop the bleeding. He held a video call with venture capitalists, pleading with them to stay calm. He flew to New York to meet with Moody's, which had warned of a potential credit downgrade. He called Goldman Sachs for advice. None of it mattered. The panic was algorithmic, social, and self-reinforcing. When every VC you respect is telling you to pull your money, you pull your money. When every startup founder in your accelerator is posting about moving funds to JP Morgan, you move your funds. The bank run wasn't driven by fear of SVB's fundamentals, though the fundamentals were terrible. It was driven by the certainty that everyone else was running. Game theory made flesh. A prisoner's dilemma with $42 billion at stake. By the morning of March 10th. SVB stock had collapsed 60% and trading was halted. The California Department of Financial Protection and Innovation seized the bank and placed it under FDIC receivership, a 40-year institution gone in 48 hours. The second largest bank failure in U.S. history after Washington Mutual in 2008, and the fastest by an order of magnitude. But the story doesn't end with the seizure, because 89% of SVB's $172 billion in deposits were uninsured, above the FDIC's $250,000 limit. Tech startups had millions, sometimes tens of millions, sitting in SVB accounts. Payroll was due on Friday. Rent was due. If the FDIC only paid out the insured limit, hundreds of companies would have failed within weeks, triggering a cascade to the entire tech ecosystem. The government faced a choice: let the free market work and watch Silicon Valley burn, or step in and backstop everything. They stepped in. On Sunday, March 12th, the Treasury, Federal Reserve, and FDIC announced that all depositors, insured and uninsured, will have full access to their funds on Monday morning. No taxpayer money was used. The cost would be covered by a special assessment on other banks. SVB was reopened as a bridge bank, and its UK arm was sold to HSBC for £1, but the damage was done. Signature Bank, another crypto-friendly institution, collapsed the same weekend. First Republic Bank, which had received billions in SVB deposits during the panic, teetered for weeks before failing in May. Regional bank stocks cratered. $100 billion in market cap vanished from U.S. banks in 2 days. European banks lost another $50 billion. That the postmortems were brutal. A Federal Reserve review called SVB's failure a textbook case of bank mismanagement. The bank had no chief risk officer for 8 critical months in 2022 while interest rates were skyrocketing. Its risk models were so flawed that they predicted rising rates would help the bank's finances. The board and management had lobbied successfully in 2018 to weaken Dodd-Frank regulations, raising the threshold for enhanced supervision from $50 billion to $250 billion, conveniently exempting SVB from the strictest stress tests. The Fed's own supervisors had flagged problems as early as November 2021. 6 citations were issued. Nothing was fixed. And yet, even with all those warnings, nobody stopped the run. Because in the age of social media and instant communication, a bank run doesn't take weeks anymore. It takes hours. The Federal Reserve's own report noted that SVB's collapse was fueled by social media and the highly correlated behavior of its tight-knit venture capital network. These weren't irrational depositors. They were sophisticated actors moving in perfect synchronization. Because in a network world, the rational move is to panic first. Greg Becker sold $3.6 million in SVB stock less than 2 weeks before the collapse. He claimed it was part of a prearranged trading plan. The Department of Justice and SEC opened investigations. Employees who had received company-wide bonuses just hours before the seizure watched their careers, their savings, and their sense of stability evaporate. One insider told CNN that employees were absolutely idiotic with anger at management. The same management that had built a bank around the idea that tech was different, that the old rules didn't apply, that growth and innovation could outrun risk. Silicon Valley Bank was supposed to be the bank that understood the future. Instead, it became a case study in how the future can kill you. It bet that interest rates would stay low forever. They didn't. It bet that its deposit base was loyal and sticky. It wasn't. It bet that transparency and goodwill could stop a bank run. They couldn't. It bet that being the smartest bank in the room meant you didn't need to hedge. It was wrong that in the end, SVB didn't fail because of fraud or corruption or some exotic financial instrument. It failed because of a mistake, so old it has a Latin name. Maturity mismatch. Borrowing short and lending long. The same mistake that has killed banks for 500 years. Silicon Valley thought it was different, that its speed, its network effects, its disruption of old industries would protect it from old dangers. But physics doesn't care about your business model, and neither does a bank run. Today, Silicon Valley Bank exists only as a cautionary tale, a reminder that in finance, the thing that makes you special is often the thing that kills you. That concentration is a feature until it's a bug. That transparency can be a weapon in the wrong hands. And that in a world where $42 billion can move in a single day, the only thing more dangerous than being too big to fail is being too connected to survive.